Good morning, this is Meir Valensky with Driving Markets. Driving while talking about markets. I hope you're all well. Let's just correct the camera a little bit there. Okay, that's it. Okay, lovely. Let's kick off. Anything said in this piece is purely an opinion. It's not investment advice, not financial advice. It just gives you an overall wrap on where we're at with financial markets. So let's look at what is driving markets today. Well, obviously, the biggest impact on markets last night was the Fed. The Fed rates went up by 75 basis points. Now, effectively, that was already built into the market. It was priced in. It was priced in on FX, on the dollar. It was priced in equity markets. It was priced in on the Nasdaq. Everyone was expecting a 75 basis point rise. There was nothing unusual about that. In fact, if we backstep and roll back a little bit where we were at a couple of weeks ago, there came a view, and slowly that view got stronger within financial markets, that the Fed is coming to the end of the interest rate cycle, or even going to lower the amount it's raising. So the amount it raises or increases interest rates. Last night was the fourth interest rate rise at 75 basis points, and that really did shudder the market. But why? Initially, when the rate came out, the market shot up. The Dow was up nearly 300 points because there was an indication in the initial statement that the impact or the effect of interest rates on the market, on inflation, is having an impact, it's having an effect, and the market shot up. And then Jerome Powell came out, who's the head of the Federal Reserve, came out and clarified that they have no intention whatsoever of reducing interest rates or slowing the pace of interest rate rises. And as a result of that, the market did a 900 point turnaround just based on that statement. Now, if you were to look back on some of the driving markets videos over the last few weeks, I've been stating over and over again, the interest rate cycle is not coming to an end. And I've been criticised and it's been commented, and I've had the professionals say, what are you talking about? You've got to look at the figures, and you've got to look at the fact of housing, you've got to look at the fact that inflation is going to go down. Interest rate cycle is not coming to an end, okay? Now, it will eventually come to an end, but when I say it's not coming to an end, it's not coming to an end in December, it's not coming to an end in January, it's not coming to an end in February, and it's not coming to an end in March. It may slow down in March in terms of they might not increase it by 75 basis points, they might only increase by 25 basis points or 50 basis points, but the interest rates are going to continue rising. We're going to see next July 7% interest rates in the US. Now, I've stated that it's a bit extreme according to the common market views, but my view was extreme at the beginning of the year when I said interest rates by year end in America are going to be between 3.5% to 4.5%. At that time, interest rates in January were practically 0 or 25 basis points. No one believed it. No one accepted it. No analyst on Wall Street accepted it, and no viewer accepted it. They all the viewers and the investors and the traders and the analysts believed that would have a maximum 1% by year end. We're now going to have 4 to 4.5% by year end in the States, and in July next year we're going to have 7%. Why? What's the rationale behind that? Everyone's saying, but you're out of touch, it's not real. And I'll tell you what's going to happen, in my opinion. The geopolitical situation with Russia and Ukraine is not going to come to an end. In fact, Putin is hell-bent on getting hold of Ukraine, okay? So what he'll do, he will impose further military and economic sanctions on Ukraine and stop the export of soft commodities around the world. The export of soft commodities will automatically push the price up, and that is a major factor and a major measure within inflation. So that's going to be increasing. That's my view. Oil is going to maintain its level at $100 a barrel. The reason being is because OPEC now has got the taste of the money, and it doesn't matter where the market's at, they're going to have a minimum of $90 to $100 a barrel. If it drops to 72 or 73, 75, all they're going to do is cut production, and therefore they're going to maintain oil at a higher level. That is also a feed within inflation. And then you've got the supply chain issue. Now, the supply chain issue is being frustrated by the pandemic. So you might say, but the pandemic's over. Well, it is over globally, but China has a zero policy when it comes to corona. And therefore, any time there is a slight increase in numbers, they close down a province. Now, considering each province is running anywhere between 50 and 100 billion people, they can't leave the house, they can't go to work, and therefore that supply chain is going to continue to be frustrated over the next year, 2 years. It's not going to go away. So that's going to have also a major impact on inflation. So inflation is going to either minimum stay where we're at the 8.3, 8.4%. In Europe it's 10.7, UK it's 10.1. But in the US I'm talking about, or personally expect it to rise to around about the 10, 11, 12% next year inflation. That will put more pressure on the Fed to increase interest rates even further. Now in the UK you've got a interest rate decision today because Andrew Bailey, who's got no balls, is spineless. He'd probably increase interest rates by 50 basis points, and he has increased interest rates the lowest amongst all the developed nations in the G7. So you can expect a 50 basis points outside chance, 75 basis points in the UK. If he was to raise 75 basis points, that would shoot the pound up on cable to about 118, 119. Let's look at a little bit regarding what's happened within the individual asset classes. So you've got dollar strength. You're going to have further dollar strength as rates rise, not necessarily against cable, because we've got Rishi Sunak and Jeremy Hunt there in the UK with a stable government. Hopefully they'll correct the UK and get the pound back on track. But as far as the euro, the yen concerned, you're going to see the yen going to 150 and the euro go down to 95. Talking to people about commodities, soft commodities will start rising as Russia bans the export of more and more grains from Ukraine. So you're going to have an issue there regarding price of soft commodities. Oil crept up yesterday to $95 a barrel. Okay, that's also going to have an impact on inflation. Cryptocurrencies, Bitcoin have become a dead cat. It's just not doing anything. All it do is sitting there around about the 20,000, 20,300, and it's not moving at all. Again, I put my money on that's going to fall to 15,000 in the near future, especially as if the Fed gets more hawkish, and that's going to push cryptos down even further. But they're not bouncing, they're not going to go back up to 68,000 anywhere in the near term. Bonds are 10-year treasuries running at 4.06, and a 30-year mortgage in the States is running at nearly 7.5%. The property prices are coming down, and there's cracks already appearing across the board in the UK, the US and Canada and Australia regarding property prices as they begin to fall, and the number of transactions is dropping very, very low. The lowest since, well, I don't want to say, but I know it's the lowest since a very long time. I'm not sure it's 2008 or before that, but I'm not too sure on that particular fact. So property prices will continue falling next year to around about 20 to 30% drop in property prices next year. That's more or less it. People have commented on it, and it's a bit long on YouTube, but this is a YouTube broadcast. So this is Meir Walensky with Driving Markets. Comment. I hope you like it. Subscribe, pass it on, and speak to you soon. Have a good day.